On Wednesday, May 1, Eastern Time, the Federal Reserve announced during the FOMC meeting that the target range for the federal funds rate will remain at 5.25% to 5.50%, which met market expectations. Additionally, the Fed will slow down quantitative tightening, QT, starting in June. Fed Chair Jerome Powell provided insights into the possible future path of interest rates in his subsequent press conference. He clearly stated that despite the easing of inflation, interest rates need to remain at a higher level given the current economic conditions. During the Q&A session, Powell declared that it is unlikely that the FOMC's next move would be to raise rates. Powell's stance, along with his openness to the possibility of future rate cuts, brought a sense of relief to the market. As Rick Reeder, Chief Investment Officer of Global Fixed Income at BlackRock, commented, the market's expectations were more hawkish ahead of the Fed meeting, but Powell's remarks allowed the market to breathe a sigh of relief. On Thursday, U.S. labor cost data for the first quarter showed an unexpected annual increase of 4.6%, the largest rise in a year. Moreover, the latest ADP non-farm employment report revealed that U.S. employment in April increased by 192,000, exceeding the expected 180,000, with March's figures revised from 184,000 to 208,000. This reflects an unexpectedly strong job market. Financial blog Zero Hedge noted, wage inflation has been confirmed, growing at the fastest pace in a year. If this trend continues, it might increase the risk of persistent high inflation in the U.S., thus putting pressure on the Fed's monetary policy. Although the Fed did not cut rates at this meeting, Powell outlined three paths where two could lead to rate cuts this year: a weakening job market or satisfactory progress on inflation. However, the third path, if inflation remains stubbornly high, could mean that hopes for a rate cut might not materialize. Chief economist Luke Tilley of Wilmington believes that the FOMC is most likely to initiate a rate cut during the meeting on July 30 to 31. His interpretation of Powell's comments at the press conference seems to hint at a higher likelihood of a rate cut in July. According to the latest FedWatch data, the market is still betting on the first rate cut in September this year, although the possibility of a July rate cut is gradually increasing. The Fed statement mentioned, recent indicators suggest that economic activity continues to expand steadily, employment growth remains strong, and the unemployment rate is maintaining at a low level. This indicates that despite facing challenges, the fundamental outlook for the U.S. economy is positive. However, the Fed also emphasized its high concern for inflation risks and stated that it is not appropriate to lower the target range until there is more confidence that inflation is moving towards 2%. By carefully analyzing economic data, the Fed attempts to find a balance between supporting economic growth and controlling inflation. The market reacted positively to the Fed's dovish stance, indicating that market participants are hopeful about the Fed's potential future rate cuts. However, the Fed also made it clear that any policy adjustments would be based on a comprehensive assessment of the economic outlook, rather than short-term market pressures.